Are you getting sick and tired of trying to pick the next winning stock only to end up seriously disappointed and worse with losses on your account? In today's video, I'm going to give you 3 simple lessons that I've taken away from Jack Bogle's book, The Little Book of Common Sense Investing. By the end of the video, you'll have a really good idea of why keeping it simple when it comes to your investment strategy is the best way to go. So lesson number 1 from Jack Bogle's book, The Little Book of Common Sense Investing, and that is to own the market overall. Instead of trying to beat the market by actively picking your own stocks, Jack Bogle says in the book, it's far better to own the actual market itself. And in fact, the return for investors is the market return minus any costs that they may have. So investors, he argues, would be far better off just taking the actual market return than trying to pick individual stocks to outperform the market themselves. He also referred to this in a very simple way. Rather than trying to find the needle in a haystack, just buy the entire haystack. Jack Bogle actually ran loads of data, and he came to the conclusion that it's far better for the average investor to just buy into an index fund tracking the main market like the S&P 500 than it is trying to outperform the market itself. Why? Because over time, the average investor cannot outperform the market themselves. In fact, as we'll see in a minute, most professional investors can outperform the market over the long term as well. So studies show that actually 90% of actively managed funds fail to beat their benchmark over a long-term horizon, being 10 or 20 years, for example. Imagine that. Over 90% failure rate in an actively managed fund trying to beat the market. So this is huge. And as Bogle says, rather than trying to invest in an equity fund that's trying to beat the market, just buy the market itself and own it, and you'll get the fair share of the market return. Okay, so lesson number 2, minimize costs to maximize return. Bogle said when it comes to investing, you get what you don't pay for. And what he really means here is you've got to keep your costs low because they can have such a huge impact on your portfolio over the long term. Let's look at an example to see this in action. Okay, so if we look on my screen here, I've got a compound returns calculator, compound interest calculator. And I've just put in the variables like if you started off with $1, you put $180 a month away, and you did that every month for a 40-year period. And I use the returns of the S&P 500, which historically is 9.8% per year. But let's assume you did this in a passively managed fund like an index fund that Jack Bogle mentions in his book, and your fees for that, let's say, were 0.2%. You can definitely get it cheaper than that, but some of them can be a bit more expensive as well. So let's say 0.2%. So what we see here is rather than getting 9.8%, you actually get 9.6% because 0.2 you're going to lose the fees, let's say. And over a 40-year period, your final return in 40 years would be a little over $1 million at 9.6% return. Okay, so that sounds pretty good. So let's now say that instead of 9.6, you've actually paid 1% per year in fees. Okay, there we go. So your return therefore would be 8.8%. And look at the difference in your total balance after a 40-year period. Instead of $1 million, you'd have a little under $800,000. That is the power of compound costs and what that actually does to your portfolio here. Now let's look and say, okay, imagine you actually were paying 2% in fees. Now I know that's on the upper end, but there are a lot of mutual funds out there that actually do this on 2% basis. Maybe you're paying other fees like currency conversion or actively trading stocks and paying fees around that. If you had a 2% cost per year on your portfolio, you would actually have at 40 years a little under $600,000. So you've lost $400,000 in this case compared to the earlier return of 9.6. $400,000 you've lost through costs alone. So that is the importance of keeping your costs low, as Jack Bogle says in his book. So just before we get into the 3rd lesson from Jack Bogle's book, I would really appreciate if you're enjoying this video, please click the subscribe button. I'm a new channel trying to grow out, and it really helps me produce content like this. I really appreciate that. Thank you so much. All right, let's get into the 3rd lesson from Jack Bogle's book, The Little Book of Common Sense in Investing. And that is to stay the course with your investment plan, long term that is. This is really all about discipline and staying the course and staying invested in the market. Remember, time in the market beats timing the market. As Jack says in this book, and he shows loads of data to back it up, which is what I really liked about this book in particular, is that nobody can actually outperform and time the market. It's just too difficult to do. The truth is, the market goes up, the market goes down. This is completely normal behavior for markets. But the key is to stay invested and to stay the course for a long term. That's how you need to do this. I recently did a video on the Ronald Read story, unbelievable story of a janitor who was able to accumulate $8 million in stocks. One of the main reasons he was able to do that was discipline. I'll put a link in the description so you can go back and watch that video. It's an inspirational story. You won't even believe it's true, but it is. But he was disciplined, and discipline is key. Trying to time the market, get in at the top, buy at the bottom, and all of this sort of stuff is an absolute disaster, according to Jack Bogle. And from what I've seen in my 20 years working in the financial markets and in the city and talking with clients, all clients who try to time the market, they end up losing. It's just the way it is. Buy and hold investors get the best returns. I've seen it many, many times. Take a look at this chart that I've got on the screen now. This is the S&P 500 going back to 1926. As you can see at the beginning there's a huge downturn being the Great Depression. And of course, this took years to recover, but it did recover, and it always recovers. But look at that line graph all the way through. It's basically going up. Yes, there are sell-offs there. The gray lines, the columns, those are actual recessions, and that's just part of it. It's going to happen in an economy. But look at the growth that it's had. Through all of that time, there have been wars, we've had a pandemic, there's been countless recessions, problems, military skirmishes, you name it, it's all happened. And look how the S&P 500 has continued to grow. You cannot pick when to enter and when to exit the market. You just need to stay in and ride it out through all of these ups and downs. So let's recap. Lesson number one, you've got to own the entire market through an index fund or an ETF. I'll put another link in the description for videos I did on ETFs and index funds as well. Number two, you've got to minimize your costs because that is going to eat into your returns. And as we saw today, it's going to have a huge impact on the amount of money that you have down the road. And number three, you just need to stay invested, think for the long term. The other thing that I really liked about this book, throughout the book, he had loads of quotes from well-known investors around the world on why index fund investing is the way to go. There's one area of the book where maybe I disagreed a little bit. He was pretty negative on the whole use of ETFs, and his main reason behind that is he thinks that a lot of people just use it for day trading, and he's probably right. But I think ETFs have come a long way, and I see a lot of people use them for long-term investing, and that's what I do. So I would disagree a little bit on his view on ETFs myself. I think they're a great way to get access to the market in the way that he says, buying the entire market itself. So I love doing videos like this to share the information that I've gained with over 20 years experience in the financial markets. And most of that time has been dealing with clients, people just like you, and helping them on their savings and investing journey. And I want to pass that on to you. I recently did a video on the Ronald Read story, the janitor that accumulated $8 million while earning a very low income. So if you want to learn how to be a millionaire on a low income salary, just click on this video right here. I'll see you over there. It's a great story. You don't want to miss it. And I wish you all the best in your saving and investing journey.